So first of all, factor timing obviously is something that a lot of people have been talking about. Cliff and Rob Arnott specifically over the last year have had a pretty rousing, interesting debate, which I will allude to as I go through this presentation. But really, we've been actually doing factor timing for almost a decade now at State Street Global Advisors. We use it in our active quantitative equity strategies. And as part of the whole factor timing debate, we sat down and Vlad is our head of research for that team. Rick Thomas is our head of research for our multi-asset class team, and I'm the head of research for our index equity team. So it's really, three very somewhat different perspectives coming in a room and saying, what do we really believe about factor timing, and what do we believe to be true, and what do we believe to be false? So somewhat provocatively, okay, I'm going to start with, is factor timing the Holy Grail? So the Holy Grail, the cup used by Jesus Christ at the Last Supper, rumored to have been brought to Britain by Joseph of Arimathea, otherwise known as focus of one of the most iconic scenes in the Indiana Jones movies. But according to Webster's dictionary, it's a thing that is earnestly sought after. And if you go by Urban Dictionary, the ultimate goal of an occupation, profession, or endeavor. All right, so I'm going to start with the fameux French factor returns. So we've talked a lot about factors today. I'm not going to go into depth about why we care about factors, other than the fact that they are sources of return we know to be systematic and persistent over time. They are durable, they are important for long-term investors. And the reason why we care is because, in essence, we found that they seem to price stock returns in a way that we can't quite explain. These are factors that basically have been around for some decades now, of course, starting with the seminal work of Steve Ross, who we're honoring later today, but then extended by Ken French and Eugene Fama. And I think it's important to know that I think today we've all sort of coalesced around this fairly parsimonious definition or a parsimonious set of factors. Now, we're not going to talk about low volatility or quality. So these are ways of investing that, for instance, our firm, we actually espouse. So I'm going to really stick to the fameux French factors because that's a common language I think that everyone in this group has. So if you look at the full sample of performance for the fameux French factors, you can see that they have pretty significant excess returns. We're all pretty familiar with these. And they have formed the basis for this $500 billion industry of smart beta and factor investing that we call today. But these factors vary in performance over time. And so what we show here is decade by decade performance, with the last decade just running through 2017. These are excess returns of the long-only portfolio of the fameux French portfolio. So fameux French is a double sort method where long and short portfolios are identified. We're going to use only the long portfolios here. So the long portfolios, the ones that have the highest returns are in the dark green, and the negative returns are in the red. And then if you see yellow, it means that the returns are relatively tepid during that decade. So this pretty much agrees with our intuition that small cap and value was pretty dismal during the second half of the 1990s, while growth did really well during that run up to the tech bubble burst. But both value and small cap were rewarded after that pinnacle and through the mid-2000s. Now, as we know, there was the sort of August quant meltdown of 2007, and ever since then, value has been unrewarded and has been pretty weak. So it's had ups and downs. And in that meantime, we've seen profitability and investment really become more of the favored factors. So factor returns have varied over time. They're also cyclical. Now, some of the things that we've observed over the last 40 years is that value, size, and momentum tend to be cyclical, pro-cyclical, so they do well during boom periods of strong economic outlook and high market sentiment. Whereas in downturns and recessions, we see that the more defensive factors like high quality, low volatility, high profitability, high investment stocks, if we're going by the fameux French definitions, tend to do better. Now, is this always the case? We know absolutely not. This is just what we tend to observe over most of the business and market cycles that we've seen. So why do they vary over time? In the words of my co-author, Vlad, I have to attribute this to him, he deems it the Entropic Principle. So without temporal variation, the underlying phenomenon basically would be arbitraged away. All right, so does factor timing actually work? All right, well, let's consider an experiment. Okay, so we'll take the fameux French long-only factors, and every once a month, we're going to have perfect foresight, and we're going to see which factors did outperform the market over the next month. And we're going to hold those factors, and we're going to equally weight them. Now, if all the factors underperform the market in the next month, then we're just going to hold the strongest performing factor for that month. Okay, so this is a monthly rebalanced hypothetical illustration. And what you get is phenomenal returns, so 27% annualized returns over this 1963 to 2017 period versus 5% for the market. So clearly, if we had perfect foresight, and we were oracles, we could actually do pretty well. And there, my friends, is why we call it the Holy Grail. Now, let's go to the literature. We have to always pay homage to John Campbell and Robert Shiller, because in 1998, they wrote a very seminal paper on the relationship between dividend yield and price to earnings and future market returns. So this is one of the charts from their paper, and what you can see on the x-axis is the dividend to price of the S&P 500 index, and what's on the y-axis is the one-year forward price growth of the S&P 500. So there's not a whole lot of relationship here. Dividend yield has little power for predicting stock price changes over the subsequent year, and it's pretty. And this has not changed over time. Now, what if we look at 10-year price growth versus the current dividend to price of the S&P 500? So now there does seem to be a relationship that emerges, and in fact, the R-square is 9%. And so what Campbell and Shiller ultimately conclude with is that if your horizon is long enough, there is a mean reversion, right, that occurs. So price to earnings multiples or dividend to yield multiples are always going to revert back to some historical mean. And it does tend to be the price that changes that brings it back to the historical mean. It brings it back to that equilibrium. So this is about earnings to price, dividend yield, and its relation to forward returns for the market. Okay, and of course, that's something that we use today a lot when we talk about factors. So moving on to somewhat more recent research, this is based on a paper by my colleagues, one of my co-authors, Rick Thomas, and Rob Shapiro, actually, who was here last year, I think, on on the factor timing panel. So here, what we're doing is we're taking the universe of global developed equities, so this is the MSCI world, roughly, and we divide it into top and bottom quintiles ranked on the factor characteristic in question. All right, now, to be clear, these are not exactly the same definitions as the fameux French factors. So value, for instance, is a composite of book to price, earnings to price, sales to price, cash flow to price, and dividend yield. Quality is a composite of return on assets, long-term debt to assets, and earnings variability. Size and low volatility are relatively straightforward. And here we are basically ranking companies within the MSCI world based on that characteristic. We divide into top and bottom quintiles, and then we take the median book to price of the top quintile and the median book to price of the bottom quintile, and then we take the difference. Okay, so it's the spread between the median book to price of the top and bottom quintiles. And a large spread, so top minus bottom book to price, means that that factor is attractively priced. A low spread means that it's expensive. And so if it's negative, it's very expensive. And what we're plotting here is that book to price spread. Again, if it's very high, this is an attractively priced factor. And we're looking at it relative to subsequent 3-year returns. So the y-axis is 3-year returns. And here you see a positive relationship for all 4 factors. So the higher the book to price spread, i.e. the more attractively priced it is, the greater the subsequent 3-year returns. And Rob Arnott and his co-authors very recently did a similar exercise just to corroborate this. They also looked at US and global data, and they looked at a longer period here, 1976 to 2015. And these are very similar, right? So these are similar plots, this time showing subsequent 5-year returns versus a valuation ratio. And you see a fairly significant relationship. So the valuation ratio here is flipped, and that's why the slope is the opposite direction. But it's essentially the same intuition as the charts that we saw previously. And I know just to point out their results, the t-stats here are significant. So I think that this is part of why there's been such a vigorous debate. So for those, I don't know if anyone from AQR or Cliff is sitting in the room somehow and I missed them, but in response to Arnott and his co-authors, Cliff and his co-authors have sort of argued that value investing or value based factor timing, right, is actually very similar to just plain old value investing. And there is a very strong correlation between the two. And that's something that we'll talk about a little bit later as well, as being something that I think is important to pay attention to in factor timing. And then finally, I want to note the really great paper by Baker and Mugler on sentiment. So this is kind of the first real seminal paper on sentiment. And they created a sentiment measure, which is a composite of closed-end fund discount, New York Stock Exchange share turnover, number of IPOs, average first-day returns for IPOs, shares of equity issues and total equity and debt, and a dividend premium. And so they identified 6 metrics which they thought really proxied well for sentiment. And sentiment is basically a fairly loose notion of an investor's propensity for fear, right? So the stronger the sentiment, the less the fear, right? And the more propensity to speculate, the lower the sentiment, the higher the propensity for fear and the lower propensity to speculate. And what they did was they looked at US data over the 1963 to 2001 period and did some two-way sorts. So each month they formed 10 portfolios. And they sorted the portfolios so that you can see the solid bars are the returns following each of these 10 portfolios after positive sentiment periods. And the white bars are the returns following negative sentiment periods. So let's just take the top left panel, panel A, which is ME, which is basically market cap or size. And small caps are, so it's ranked small cap to large cap, right? So it's ranked by cap. And small caps are on the left, that's portfolio 1, and large caps are on the right, that's portfolio 10. So after periods of positive sentiment, so that's the dark black bar, the large caps tend to do better. So high sentiment favors large caps. Now, if you look at firm age, which is panel B, you'll see that similarly, that black bar is rising, right, as it goes from left to right. And this is the age of the company. So high sentiment is also favoring older companies. So you read these charts all the same way, and what we see is that high sentiment favors dividend-paying companies, low volatility companies, value or cheap companies, and it penalizes the opposite. It penalizes young, small, unprofitable, non-dividend paying companies. And then lastly, another example of the literature is from my ex-colleagues at MSCI, Kurt Winkleman and his colleagues, and they had done a lot of, they've done a lot of great work on the relationship between factors and macroeconomic movements. And it actually builds off of research originally done by Bruce and Ken back in 1989 that actually applied a vector autoregressive model to predicting factor returns. So that's probably why they've done so well, by the way, and why we're having this conference right now. No, I'm just kidding. Now, so if you look at what Kurt and my ex-colleagues did, they basically looked at the impact of persistent shocks to trend GDP growth on the asset cash flows of different factor portfolios. All right, and so this is a long-run vector autoregressive model for real GDP growth. And they find that there is systematically a stronger response by small cap and value stocks compared to their large cap counterparts and their high growth counterparts. So they're not predicting returns, so that's important. They're predicting dividend yield here. And so in order to sort of turn this into a factor timing model, you still have to connect the dots between dividend yield and returns. That said, though, I think it's pretty interesting what they've done, and I think it does underlay, this kind of intuition underlays a lot of the macroeconomic-based timing models you see today, and similar to the one that we run in-house. So just to summarize, a lot of the literature does arise from the original papers that looked at how do you predict market returns. A lot of different variables have been advanced or put out there. It's still, of course, incredibly difficult to time markets, right? And that is a separate holy grail in and of itself. But there have been some different measures proposed, everything from the metrics that we just looked at, like earnings and dividend yield, to some of the macro factors that Andrea presented earlier, like term spread, inflation, et cetera. And so if you take a lot of the literature that we see in the factor space, and I think a lot of this has been done more on the industry side and not so much on the academic side, again, it builds off of that foundation for the relationship between market and future, the relationship between current characteristics of the market and future market returns. So again, the literature here, as you can see, is still relatively sparse. I think there's a lot to do, and it's not easy, right? I think those that have done it best have tried to stick to one factor, tried to keep it relatively parsimonious, relatively simple. So which signals might predict factor returns and why? Okay, so I think taking a couple steps back, Rick, Vlad, and I sat in a room, and Shiller, our fourth co-author, who's here in the audience, by the way, did all the heavy lifting on this project, was there to witness this interesting debate. And we talked about which of these candidate predictors that you often see do we believe in might actually predict factor returns. And not surprisingly, there was a fair amount of disagreement. Okay? And I have enormous amount of respect for my colleagues because both of them have been in the industry for 25 years and know, quite frankly, a lot more about real markets than I do. So I'm probably one of the babies of the firm. But if we look at some of these different metrics, right, they make a lot of sense. So financial conditions generally reflect the aggregate state of the financial markets and how sound or stable they are. Now, they're very closely linked to economic conditions, but they're not perfectly linked. So you can have times when the financial markets are in somewhat state of disruption, whereas the macroeconomy is chugging along. But economic conditions do generally reflect the state of the economy and do have an impact on the way investors behave. Third, we have sentiment, similar to the Baker and Wurgler notion of sentiment, and this is really a rough proxy of the propensity of investors to speculate or the propensity of investors to be fearful of the future. So we can think of this almost as that sort of risk-on, risk-off perspective. And then valuation and trend or momentum. Valuation we talked about at length. We haven't really talked about trend or momentum, but it stands to reason that if momentum works for individual stocks, it might actually work for factors as well. Now, examples of the individual metrics are shown. And for those of you, who read broker reports, these are all fairly common measures that we use in the industry. So then the debate is really around, well, which of these things should predict what, right? Because we're not we don't want to data mine, right? I think there's a lot of talking about overfitting, and I think one of the things we care about the most is to make sure that we have sound economic intuition behind anything that we test. So it's very clear what the right sign should be for factor valuation and factor momentum. All right, if a factor is cheap or attractively priced today, then we expect it to have positive returns going forward. Well, here I've got the negative sign. So if it's expensive today, it's negative tomorrow. And then if a factor has been experiencing strong price performance in recent months or years, then it should continue to have strong price performance going forward. Sentiment follows the sort of Baker and Wurgler intuition, which is not surprising. So when investors have a high propensity to speculate, they like small caps and value stocks. And when they're worried about the markets, they are worried about whatever's happening in the state of the world, they prefer high quality, which is profitability and investment in the pharma French world, and low volatility. And you'll notice there that we put an NA for momentum. So momentum is a very difficult one to sort of fit into this framework. It tends to perform well when the state of the world is trending. So if you've seen the state of the world moving in one direction, and when I say state of the world, I mean that in a very loose way, whether or not that's risk aversion or sentiment, momentum tends to work well, but then at turning points, it ceases to work. Now, the fourth row is the measures of risk, so corporate credit spreads, think TED spreads, et cetera. And there, you'll notice the positive / minus. They're not to confuse you, right? But the idea being is that if we think that corporate credit spreads, TED spreads, and other things are basically reflecting the price of risk, then as those things go up, investors should demand a higher premium for the price of risk. And that means that it should have a positive impact on future size and value returns and a negative impact on high quality and low volatility returns. Now, let's take the other view, right? Let's say that we don't think widening spreads is actually reflecting the price of risk, but instead it's actually reflecting risk aversion. Well, if it's reflecting risk aversion, then it will actually imply the opposite. So as risk aversion goes up because spreads are widening, it would actually favor high quality, low volatility stocks, and it would penalize small cap and value. So again, here, we don't really know. We can debate about it, and between Vlad, Rick, and myself, we all had strong preferences leaning one way or the other, but short of doing a vote, I don't think we actually did settle this. And similarly for measures of economic outlook, I think there with value momentum, it's kind of the same story. But here with size and quality and low vol, it's a little bit more straightforward. And again, that's why financial metrics and economic metrics are not perfectly aligned, even though they do often reflect sort of generally what's happening in the world. So when the economic outlook is strong, so say when the term spread is steepening, that is favorable to size and value most of the time, and not favorable to quality and low volatility. On the other hand, some of these measures can also reflect changes, the opposite changes, which is why you see that plus or minus for value. So I spent a lot of time on this slide, and it is really trying to reflect what our priors are going into any sort of discussion about the empirical evidence. And next, I think what we'll do here is just kind of talk through some of the actual empirical relationships we see. Many of you are familiar with this, but I think it's always good to sort of refresh our data, take a look at what's been happening more recently. When I say recently, of course, you'll notice that this runs through July 2015, and that's pretty much how long it takes to actually finish a paper and submit it for publication, as many of you know. So again, we use the Fama-French factor portfolios here, and we use the long-only portfolios. Again, we could have used a long-short. It was just a matter of preference because we tend to be a long-only shop, and we tend to think of the world in terms of long-only portfolios. There is a vigorous debate on the best way to capture factor portfolios in real life. I do want to mention that. So we do a lot of research on what is the best way to implement value, what is the best way to implement size, et cetera, in a long-only portfolio. And I want to make sure that that is in some ways kept very separate from this exercise because factors are ultimately unobservable, right? So even the Fama-French portfolios are trying to capture factors that are essentially unobservable. And coming from a Barr background, where and I still consider myself a Barr person, even though it's been a while since I've been there. We always thought cross-sectional regression is the only way to actually identify factor return. So no slight on Fama and French. But we are using their portfolios here. All the portfolios are cap-weighted. They're annually reconstituted. And they have relatively reasonable turnovers. So I think it's important to point out annual one-way turnover of 30% for most of these portfolios, which means these are actually implementable, right? That's about 10 to 15 basis points annually for an actual portfolio. Some of our candidate predictors, and I know you're not going to be able to read anything on this slide. It's always, it's a pet peeve of mine when I'm in an audience and I see people with these slides with tiny, tiny font. And of course, half of my deck has tiny, tiny font. So, but at any rate, you have a number of financial conditions here, like the corporate credit spread, TED spread, term spread, money supply, money base, the Dow Jones Industrial average index, and bank loans. We also have a number of well-known economic condition variables, so GDP, personal consumption, current account, unit output, et cetera. All of this data is sourced mostly from DataStream, which tends to be the most reliable data set when it comes to looking at variables as far back as possible. And then next we have variables for the housing market, so sales of new homes, sales of existing homes, units of housing started. We have the sentiment variables. So here we've actually included the VIX average, but we've also included the 4 sentiment variables of the Baker and Mugler paper. And cent and cent with the thing are 2 variations of that paper, and then decent are the changes of sentiment. We also include ISM's Purchasing Manufacturers Index here, which we think is a good one. And then Shiller's indicators like the CAPE ratio, dividend yield, and earnings yield. And lastly, factor momentum past 1 month, 3 months, 6 month, 1 year, 2 year, 3 year, and 5 year performance. Now it does start to feel like data mining, which is why it's so important that we spent time on that earlier slide. So now let's look at our intuition. So earlier we said the TED spread, which is a measure of, is a financial condition measure, right? It could go positive or negative either way, depending on whether or not we thought the spread widening was reflective of the price of risk or whether or not we thought it was reflective of rising risk aversion. And what you see in practice here is pretty interesting. So first of all, the correlations are, for all the factors, are actually very strong. So 27% for size, 28% for value. So this is the TED spread versus the forward 1-year factor return excess of the market. Profitability and investment are also strong, and momentum is interestingly strong as well. So it does seem to indicate that it's kind of doing both things, right? So the fact that it's positively correlated to size and value is supportive of the spread reflecting the price of risk. The fact that it's positively correlated to profitability and investment is synonymous with the other narrative, which is that the spread is reflecting risk aversion. So these are over multiple market cycles, right, and multiple time periods. And what you get is basically kind of a mixed bag, that it could be either of these things driving it, but at the end of the day, you do see positive correlation between the TED spread and the future 1-year returns of all these factors. So let's take a look at the investment premium. There is a pretty good intuitive story. So a widening TED spread should mean higher liquidity risk, which has a negative impact on firms with aggressive investment. So you should see a very positive relationship, statistically significant, between the TED spread and the 1-year forward investment premium. And that is what we see. So on the previous slide, that correlation was 32%. And when we look at how these 2 time series evolve over time, you do see that in all these periods where the TED spread shoots up, you get a corresponding positive investment premium the following year. So this is something that I think is pretty nice and intuitive and agrees with what we would think a priori. So the term spread, similarly, we said signals economic growth, and the flattening would probably favor defensive factors like the profitability and investment factors. And here you get basically the right sign for profitability and investment, because as the term spread goes up, the term spread is steepening, you should get negative profitability and investment, and you do get that. So you get minus 46% correlation for profitability and minus 37% correlation for investment, which is great. So it ties up with what we would expect. The other factors, however, come out a little bit different than what we would expect. So for value and momentum, those are not the signs that we would have predicted. Again, looking at the term spread with just its relationship to term and profitability, to profitability on the bottom chart, you can see that that very negative relationship is holding true, particularly at the periods where the term spread is moving dramatically. And finally, our last example is the corporate credit spread. So the corporate credit spread has a very similar intuition to the TED spread, where it is either reflecting the price of risk or it's a proxy for risk aversion. Here, it favors size and value, so there is a positive correlation with size and value of 15% and 16% respectively, but not quite as high as we saw with the TED spread. those two signs are consistent with the notion that the spread is reflecting the price of risk. It does favor investment too, but for some reason it doesn't favor profitability. So here we get a slightly not as strong relationship as we might expect. So now I'm going to turn to some pretty crazy slides here. Hopefully you'll be able to see the colors at least. So what we've done now is taken a look at not just 1 year forward returns, because that's what we were looking at before, but we're going to look at a couple of different horizons. So forward 1 month returns, forward 3 month returns, and forward 6 month returns. Here we've actually taken out, we've also looked at 2 year, 3 year, and 5 year, but for this particular chart, we've removed those. And what you're seeing here is the, just the correlation between the two variables. Okay, very simple correlation. Most of these are actually statistically significant, which is kind of interesting. But the darker green is more positive, the most positive, and the darker red is the most negative. So the thing that kind of jumps out here is that as the horizon lengthens, these relationships get stronger. I think that's very intuitive when you think about the Campbell and Shiller framework, right, that there seems to be a lot of noise at 1 year horizons, but at 10 years, there's some more, some stronger relationships emerge. The same thing with economic predictors and forward factor returns. Here we have some of those economic predictors I talked about, like GDP growth, personal consumption growth, et cetera. You'll notice there is a red, sort of red section, okay, about a little bit in from the left, and that column is unit output growth, which is very interesting. So unit output growth tends to have a very strong relationship with all of these factors as you go, as you move out into the 2 year, 3 year, and 5 year horizon. Other variables are personal savings rate, CPI, and PPI. Those seem to have very positive relationships that really get stronger as you lengthen out into the horizon. Then valuation, this is kind of interesting too. So this is actually housing sentiment and valuation all put in one table. On the very left, the housing stuff is actually not very informative. There doesn't seem to be a whole lot of relationship between the housing indicators and any of these factors. Whereas for the sentiment variables, it's a mixed bag. So there are some statistically significant relationships, but they're not monotonic, right? And it's hard to make of why they sort of bounce back and forth when you look at different horizons. But for valuation, that is very consistent. So you see as the horizon extends, these relationships get stronger, stronger, and stronger. And then finally, for past factor returns, again, as the horizon extends, you get stronger and stronger factor returns. So to summarize, the correlations between the term spread and the profitability factor are negative as our intuition would have suggested. And that's true across all horizons, and it becomes increasingly true as we extend the horizon. Both the TED and the term that we looked at are reasonably strong predictors for all horizons that are greater than 6 months. And that's particularly true for the value, profitability, investment, and momentum factors. Of all the candidate economic variables, there weren't that many that really had strong relationships with these, but the 4 that came out were unit output growth, personal savings rate, CPI, and PPI. And finally, VIX and sentiment measures had strong predictive relationships only at 1 year horizons and up. Valuation was pretty robust, and it was pretty robust across all factors. And past factor performance tended to work at 1 year and greater horizons. Okay, so these are just empirical observations again, right? And the last empirical observation we'll make is that, we've been looking at correlations, which are just very simple. What is the linear relationship between two variables? But of course, economic and financial conditions could have states of the world, right? They could actually have 2 or 3 or 4 states of the world, and it might actually not be very relevant to look at strict one-for-one linear relationships. So just a simple exercise, if we actually categorize the same candidate predictor variables into 3 states, so low if the predictor value is less than the 15th percentile, mid if it's between 15th and 85th, and high if it's greater than 85th, we can observe what the returns would have been like in these states. Now, this is full sample, so I just want to make sure everyone knows that we're not trying to actually predict factor returns here. We're just looking at the relationships. And these are the average returns for the low, middle, and high states for some of the factors that we've looked at. And the thing that really stands out is all of these corroborate the same signs that we saw, right? So for the corporate credit spread, you see that higher corporate credit spreads favor small cap companies there. You see how the high portfolio has a 13% return versus the low portfolio, which is 1.8. It favors value, it penalizes profitability, and it's a little weird with momentum, with investment, sorry. And then the TED spread, though, that was what we saw. It was very, very consistent across size, value, profitability, investment, and momentum, right? So very, very strong positive relationship. And so what really interests us is how statistically significantly different the low and high are, because these are long-only portfolios, and these are basically measures of how much performance we could essentially eke out if we were able to either go long high and short low, or overweight long and underweight low. And these are the high minus low returns. They're large, and all the ones that are in green are statistically different from zero. So there does seem to be some evidence that I would say that there is evidence that if you can identify the actual structure of these factors over time, whether or not that's linear or nonlinear, you can eke out performance in a fairly meaningful way. So now I have to turn to the dark side. I like the term dark side, by the way. It's a great term. So that I have to turn to the dark side of factor timing, because so far it seems like, well, if you torture the data enough, right, you can come up with some pretty nice relationships. So the first sort of major pitfall is the fact that there are time-varying relationships. And this is probably the most well-known and most shining example of that. And so you have the corporate credit spread here in the dark blue line plotted against the value premium, the forward 1-year value premium, excess of the market. And what you see is really startling. So particularly in 2008, 2009, during the global financial crisis, the spread widened dramatically, and at the same time, the value factor did extremely well now in the subsequent year. Whereas if you look back at the dot-com bubble burst, the spread widened dramatically, and the value premium was rewarded, whereas it was opposite in global financial crisis. So what was different about those two periods, right? So during the dot-com bubble, value was deeply out of favor leading up into the bubble because investors were favoring IT stocks and investors were favoring growth. During the 2008 crisis, that was a very different story. Investors were actually generally favoring value because value were basically bank stocks and financial stocks that were really benefiting from the mortgage-backed securities boom, and there were very different dynamics at play. And how you see those dynamics is actually in the beta of value. So the beta of value was very different between the height of the dot-com bubble and the height of the market right before the global financial crisis. So during the dot-com bubble, you can see that value had a very, very, very negative beta here. So down to minus 0.6. Okay, this is the beta of the Froment-French the long value portfolio. Whereas at the height of the global financial crisis, or the markets leading up to that, it had a very positive beta. So if you were to build a factor timing model for value, the obvious conclusion from these charts is that you would probably want to control for beta of value or other economic or financial market indicators. The next pitfall is around the benefits of cherry picking with perfect hindsight. So this is an example where we stood back in 1989 and we said, okay, let's run a bunch of regressions seeing which factors would have been statistically significant predictors using 1972 to 1989 data, okay? And we did this out of a candidate 38 factors, which is a subset of the more meaningful factors we saw in the previous slides. And you can see that using different horizons, you get a lot of predictors, right, that are statistically significant during that first period, 1972 to 1989. But then, going forward from 1990 to 2010, how many of those same predictors actually hold up? How many of them are actually still statistically significant with respect to those factors? And that number drops off dramatically. And this directly indicates why it is so dangerous to look purely at the data with no economic intuition and say, these factors have worked well historically or have had strong relationships with these predictors, and this is what we're going to model going forward. So how do we overcome the challenges of building a factor timing model? And here I'm going to have to, I can't show you because as my compliance team, no, I'm kidding. So this is probably the first time you've ever seen anything like that. So State Street Global Advisors is part of a global SIFI, which means that compliance and regulations are very important to us. No, that's it. So I think they even said past performance is no guarantee if future performance is in there. Okay, so the first illustration here is just a linear timing strategy with factor valuation. So this is MSCI World again as a universe. And we are taking 4 portfolios, a equal weighted portfolio, which denotes size, a value portfolio, a quality portfolio, and a low volatility portfolio. And these are all, by the way, transparent smart beta strategies that we run at State Street Global Advisors. And we're going to equally weight these 4 portfolios and rebalance monthly. And whenever the book to price spread declines below 1 standard deviation, minus 1 standard deviation relative to the average spread, we're going to sell out of that portfolio. So remember, going back to those charts, when we saw that the spread was very high, that was when a factor was attractively priced, and when it was very low or negative, that's when it became expensive. So we're saying here, when it becomes very expensive, below minus 1 standard deviation, deviations expensive, we're going to sell out of that portfolio, and we're going to not buy it back for at least 3 years. Okay, so this is a very slow-moving, long-term form of timing. And the returns are shown here. So the static portfolio over this 93 to 2014 period, so if we didn't time at all, the excess returns would be 178 basis points. And adding the timing, it's 260 basis points. The tracking error does increase, though, so the IR is only somewhat improving from 0.52 to 0.63. That said, I mean, this is a very naive, very simple strategy. And over the long run, it has produced what we think is a fairly significant amount of excess returns. This is very much in keeping with sort of the Rob Arnott argument. So I don't know how the AQR guys would feel about this, actually running this kind of strategy in real life. Now, what we actually do at State Street is a more complicated model. So we have actually built a structural multivariate panel regression-based model. It uses 5 main ingredients, including many of the ones I talked about before: factor valuations, factor persistence, where we are in the business cycle, the risk appetite of market participants, and the macro environment. The important thing is that they all are conditioned on each other, right? So similar to the example we saw with corporate credit spreads and value, they interact with each other. And so if something can be attractively priced, but it can be out of favor by one of the other metrics, and it's conditioned on those metrics, and it's conditioned on those metrics in a way that recognizes that there is a time-varying relationship between all of these different factors. So this particular model, as you can see, generates about 100 basis points over the static portfolio, and it has a very high IR of 1.17. So it's a little slightly different time period than the previous chart, but if you were to stack up the time periods so that they were the same, the IR would still be about 20% higher than that simple valuation-based model. And so this is basically where we are today. I mean, we're in the state of the world where we recognize that building a factor timing model is extremely difficult, and there are a number of challenges to overcome. And it is all too easy to get sort of caught up in what data relationships we've observed historically. So we think that if you're going to actually build a timing model and use it in real life, you either do something fairly simple and understandable so that you understand when it doesn't work and you have sufficiently long time horizons. So we certainly wouldn't advocate using valuation for a, say, portfolio that's turning over every month or every quarter. If you are going to actively factor time, then you need something that's very dynamic, and you need something that does take into account all these various relationships and some of the pitfalls that I mentioned earlier. So I'm going to stop there, and I will turn it over to Josie.
My name is Josie Smith. I am a senior researcher in the factor-based strategies group at BlackRock. So I'm going to spend the next 15 minutes, which the timer is not on here, but I will try to keep myself on a 15-minute buffer here. The next 15 minutes kind of going through the ideas that Jen just proposed, and then moving from there into some critiques and how it relates to what we are actually doing at BlackRock. So the paper addresses what I would call one of the hottest topics in factor investing right now, which is, can investors actually outperform the market through dynamic allocation across equity style factors? Now this paper, as I'll talk about in a couple slides, really just focuses on equity style factors. So there's still also a long run debate on whether or not we could do this in fixed income, commodities, currencies, so on and so forth, or even across asset classes. So without giving it all away, the answer is yes, you can time these factors, these equity style factors, but you have to take it with a grain of salt. There are caveats, hence the title of the paper. So the authors focus on the relationship between several empirical predictors of factor performance and emphasize the importance of the investment horizon. Again, this gets back to what Jen pointed out about Campbell Shiller. We know that as the investment horizon increases, these relationships get stronger and stronger. So different predictors of factor performance are going to work for different factors over different horizons. So there's a lot of different in that statement. So that is one of the caveats to keep in mind. So this paper fits very well within the broader literature of factor timing, factor tilting, factor rotation. Those all mean the exact same thing. It's just marketing to the extent of what you call it. So my colleagues at BlackRock and my team, so my team is run by Andrew Ng, but alongside Kat Hogan, our CIO of investments for the Factor-Based Strategies Group, and Justin Peterson, one of our researchers, they have a paper forthcoming in the Journal of Portfolio Management called Factor Timing with Cross-Sectional and Time Series Predictors. And it's asking a very similar question through the lens, because we were thinking of, we're an asset management team, we were thinking of, can we actually implement factor timing strategies in a way that our investors could actually buy? And that was the goal of this paper, was to actually find an implementable factor timing rotation strategy. We use a mean variance optimization. We use a borrower risk model in our mean variance optimization. But what we really try to do is find different factor predictors, construct them at the individual equity level, so down to the single name stocks, and then aggregate them up to match the constituency of MSCI Smart Beta indices, which we have ETFs trading on. So essentially what you're doing is you're replicating valuation predictors, momentum predictors, economic regime predictors of these actual portfolios. So not long only Fama French factors, but actual securities you could buy for 10, 12 basis points and implement them in a portfolio. So in that paper, they look at both time series, hence the name, time series and cross-sectional predictors of equity style factors. So we currently manage a strategy that we call the factor rotation strategy on our team. So in just a couple of months, we've raised over $500 million in this strategy. And it's very, very simple. So you and I could actually just go on our Fidelity account right now and implement this strategy for free, save for the expense ratio of the ETF, on a monthly basis. It's just 5 ETFs. The holdings are produced. That is what you hold in your portfolio. It's long only in iShares Smart Beta ETFs. So henceforth, going for the rest of this week, we tend to call this factor rotation, factor tilting at BlackRock, but I'll call it factor timing here on out. It all means the same thing. If you hear me slip and call it factor rotation, I apologize. I'm just talking about the same thing. One of the things that we focus on at BlackRock, and one of the main goals of our team, and this fits into the broader scope of today's conference, I've been sitting through and listening. The last panel was really insightful, talking about where factors have been and where factor investing is going. Factors are not new. There is nothing new about this. BGI, which BlackRock sort of took over, has been doing quantitative factor investing for decades. So the authors in this paper define a factor, and I'm quoting them, as an attribute relating a set of securities returns. So as I said, this paper is focusing solely on equity style factors. It's not focusing on macro factors, although they have macroeconomic predictors of equity style factor performance. But they're not trying to predict sort of beta-oriented macro factors. They're trying to predict equity style factors. But one could say, as I pointed out, there are macro-oriented factors in this analysis that are really picking up a lot of beta phenomenon. And I'll talk about that beta relationship with equity style factors in a few minutes. So the definition that we use, so anyone who works at BlackRock now can tell you exactly what a factor is. All 13,000 plus employees could tell you that a factor is a broad, persistent source of return. When I meet people now, people from all over the world who are coming in to talk to us about factor investing, they know how to talk about factors as broad, persistent sources of return. The key with this, and the key why factor timing can actually work and why you can believe in it, is because these factors themselves are defined over the long run. They provide you returns over the long run. We know that they are cyclical. We know that they are cyclical. But if you believe in the fact that if you hold these factors, they will provide you with return compensation in the long run, you're halfway there. So the idea of factor timing is to really just take advantage of these long-run definitions. So the authors do key into in the paper what we think of at BlackRock as the 3 main reasons that factors exist, and this is what academics study. Why do factor premia exist in different markets? So you've got risk premiums, you've got structural impediments. So this is the reason why we think low volatility or minimum volatility exists in markets. You have a whole series of investors who can't actually short. What that means is to hit their return targets, they need to buy higher vol stocks, thus affecting the price of the low vol stocks and giving you your min vol premium. And lastly, behavioral biases. And we think of momentum as kind of the most obvious behavioral bias in that investors are chasing winners and selling losers. So the success of factor investing, whether you're an investor that just holds factors and just holds them statically from here on out, or someone who tries to dynamically time them, is not only that these style factors are in and of themselves broad persistent sources of return, but I would say just as important is that they are diversifying to each other. Value and momentum are the easiest example. If a stock has been performing well and it has good momentum, that means it's getting more expensive, probably not a good value play. So just kind of the intuition states that value and momentum premiums should be negatively correlated to each other. Now, they're not always negatively correlated to each other. So are these correlations always stable? No. And this is part of the reason why factor timing can work. If you can time environments in which these correlations are going to change, you can time appropriately the dynamic factor allocation across value and momentum or other style factors as you see fit. So that's a key component of it, and I'll talk about more how that relates to economic regimes in a little bit. So I'm supposed to be the discussant. This was a really great paper to read, so I think I'm supposed to provide critiques in some fashion. So these are just critiques kind of on both the exposition of the paper, but as well as some ideas. So one thing I think the authors could take more care into doing, because I think it is important from a quantitative asset management perspective, are you looking at time series predictors of individual factors, so just looking at how value will perform over time, or are you looking at cross-sectional predictors? So at any given point in time, how will momentum versus value perform? It's key to tease that out to understand whether or not you're actually just picking up beta risk. And the academic and practitioner literature is completely mixed on this, so there isn't a right answer. I'm just kind of pointing out that that's a good thing to also think about when if you're thinking about actually constructing portfolios of these types of factors. A couple of exhibits in the paper seemed, I couldn't understand them. They were talking about valuations of particular factors, so cleaning those up would be nice. One thing, and I actually enjoyed that you had a table where you had lots of pluses and minuses, where you thought really hard about that table, and you had a sentiment row, you had momentum, and there was a not available. So that comes back to thinking about how are momentum and sentiment related, because we often use those terms interchangeably at BlackRock. We actually sometimes call momentum sentiment. So thinking about at a deeper level how sentiment and momentum are related is something that could be fleshed out more in the paper. You say one of the pitfalls is data. So data is going to be one of the pitfalls. Whenever you're doing sort of out-of-sample analysis, you want to make sure the data you're using is real time. I'm not sure if some of the data stream data that you were using, particularly the macro data, was real time or revised. Sort of when we're constructing our portfolios, everything is in real time. Data stream is great for that because it does provide you with the unrevised data. So being careful of that. I just had a small question given the fixed income nature of I'm a fixed income person primarily. Why is the term spread 20 years minus 3 months? Did you just want to maximize kind of the spread and get the most volatility that you could? So robustness on that. What I really liked, and this is something that BlackRock we try to do as well, is when you're thinking about factor predictors, to use both price-based and non-price-based measures. Because one of the worries is if you use price-based measures, like the TED spread, for example, inevitably you're just going to be picking up a return and forecasting a return on a return. And eventually it can start looking like momentum, rather than the financial predictor you're trying to actually capture. So just keeping that in mind, using returns on returns. And also one of the things I didn't see in the paper was how correlated are all these factor predictors over different horizons. Because you have a lot of them, but how correlated are they? So that's interesting to understand, because that could have power in terms of how you understand the relationships with the factors going forward. So she spent a lot of time talking about how factor predictors themselves relate to individual factor long-only Fama-French factors. In the intro to the paper, you talk about low volatility. You talked about it today, and then you don't use it. And it's probably just because there isn't a long-only Fama-French factor for low volatility. But especially in a world where you're trying to time factors over time, having a factor like low volatility in your arsenal is really important because that's going to help you the most when value and momentum are crashing the most. So just thinking about that more holistically, you could use other factor portfolios. You could just use the MSCI indices. Rather than long-only Fama French portfolios, we have other alternative forms of these factor exposures. Or you could construct your own. It's not surprising, again, Campbell Shiller tells us these correlations become higher at longer horizons. But there were some, and you pointed this out, there were some non-monotonic relationships that were a little bit puzzling to me that could be more interesting to look into. The authors, and she said this today, realized that cherry-picking factor predictors that you like the most because they perform the best. That's a really important thing to notice. But the key, again, with factor investing is to rely on the fact that these factors are meant to perform over the long run. Part of the reason that certain predictors in the paper that she shows seem to not work well might actually be because of the actual portfolio you're using to represent the factor rather than the predictor itself. So if you just had a smarter factor representation, and I'm not saying Fama French isn't smart, it's just a different factor representation, maybe, or a long-short factor representation, what have you, maybe then you'd see more predictive power of some of the predictors you've proposed. However, it's the case that a lot of these predictors themselves have cyclicality and out-of-sample performance, but that's why they should be combined. So when you start thinking about the factor timing model, which she was focusing on, when you start combining these factors, the key is these factor predictors can work best actually in a combined fashion. You could have, say, 5 different factor predictors, each on their own has an IR of 0.2, but you add them together, and if they're uncorrelated with each other, the end IR is 0.9. So on their own, they don't look very good. They wouldn't make it through, a BlackRock quantitative research investment process, right? But when you combine them, they do. And that's what the paper that came out by my colleagues, well, it's forthcoming by my colleagues, really focuses on. So the last thing I want to talk about, it's my opinion that when it comes to factor timing, the single most important thing for your model when you're trying to time across equity style factors is being able to predict the economic regime that you're going into. If you can do that, that strategy we've shown in the paper gives you an IR of almost 1 on these kind of long-only, naively constructed MSCI Smart Beta ETFs. So we have a proprietary model that generates out-of-sample predictions on what regime you're going to get into. So I've kind of stolen these from that paper. The top plot shows you the time series of the economic regimes. So each color is a different economic regime. The bottom plot shows both the unconditional and then regime conditional Sharpe ratios of the 5 MSCI Smart Beta factors. So you can see, obviously, there's a lot of cyclicality in the factor performance. And it makes sense. It gets back to the table that Jen showed with the pluses and minuses of when we think particular factors are going to work as a function of the business cycle. So understanding future economic regimes will not only aid in understanding when a single factor, say value, is going to outperform the market, but also when value might outperform size. So again, time series versus cross-section. An economic regime prediction can get you both of those. Okay, so that's kind of the most important thing. That's what we spent the majority of the time in this paper really focusing on. And this economic regime model is used on multiple teams, multiple quantitative teams at BlackRock, and uses both kind of coincident and leading economic indicators, both publicly available as well as proprietarily constructed. So with the last minute or two that I have, let me just wrap it all up because, again, most of the talk until the very last couple of slides, and in fact in the paper, it's the very last paragraph of the paper, talks about the individual factors themselves. But then how can we use these factors together? And I think that's what the paper that my colleagues focused on, that's what they wanted to build a portfolio that times these factors. So you always have to be holding the factors, but how do you overweight and underweight particular factors against each other? So I would love to see, if possible, although you had the disclaimer, love to see, if possible, more transparency around how that factor timing model was put together. We tried to provide as much transparency as possible in the paper that we published. We provide monthly commentary. Our model rebalances monthly. We provide detailed monthly commentary to our clients who are following that portfolio for them to understand as much as possible why particular factors are going into and out of favor. Again, a lot of it has to do with changes in the economic regime, but other things like valuations, momentum, the dispersion of a particular factor, do we see that it has a lot of opportunity set, so on and so forth. We go into great detail about that. But in the last 30 seconds, let me just say my last point, and this is where this paper gets it right on the money, and I think this is such a key component of thinking about managing a multi-factor portfolio where you're timing factors. If you just have a strategic portfolio where you're, say, equally weighting 5 different factors, you're going to beat the market cap. You're going to. Not every single period, but on average, you're going to beat the market cap. She showed you that picture, right? So a static portfolio of factors, because they are well diversifying to each other, is going to beat a market cap index. If you want to go beyond this, it's really important to understand where you're taking your active risk. Are you taking your active risk relative to an MSCI World, or are you taking your active risk relative to a static factor portfolio? So when we're thinking about how we construct our factor rotation model, that is a critical question for us. We want to understand, because our clients care about both, right? If we just beat MSCI World, they're like, well, do you really have skill then? Because you could just hold a 20% allocation to 5 different factors and you'd still beat MSCI World. So it's really important to be able to understand exactly where the return is coming from. And if it's relative to market cap, and this gets into the timing component in the time series, how much of it is just beta, right? In particular being low beta. So it's very important to understand that at moments like the GFC, having that ability to be low beta is what got you through the GFC. Okay? So it's also understanding how much of it is just low beta versus really genuinely timing the market in a cross-sectional fashion. So with that, I know I went about a minute over time, but thank you so much for inviting me. Jen, this was a great paper to read, and we look forward to your questions.
These are all really great comments, and I actually do appreciate all of them. And I do think that some of the comments about differentiating between the cross-sectional versus time series relationships, I think, were key. We did not do that. I also think it's quite amazing that you were able to be fully transparent, or pretty close to transparent in the paper coming up, so we're looking forward to reading that as well. And I do think that forecasting economic regimes in and of itself is very difficult, so look forward to seeing how you do that as well. So I think all good comments generally, and I think me and my co-authors will take back the good feedback.
Hi. Can you please discuss some of your methodology to build the economic regime model? You know, not in detail, but high level. What kind of underlying models you use to come up with your whiews for economic regimes?
Whom are you directing the question to? Both?
To the
Josie?
Jessie.
Josie, yeah.
Josie, yeah, okay.
So that's a great question. So yeah, my microphone's on. So I talked about it briefly, but we use both coincident and leading economic indicators, essentially in a Markov switching fashion to figure out which regime we're going into and out of. Obviously, it's more complicated than that. It's proprietary. Most of the input data to the model is actually publicly available data, whether it be coincident or leading economic indicators. There's very little inputs to the actual model that we construct ourselves. Some of those inputs we construct on our own team. Some come from our model-based fixed income team. It's kind of it's an example of kind of good collaboration at BlackRock putting it together. But it really is kind of a standard Markov switching model to understand which regime we think we're going into and out of.
And yeah, and if I could just add, so we do have a macroeconomic regime model embedded in our factor timing model, the one that I showed on the very last slide that I couldn't release the details of. And there we predict 4 states of the world. So similar to the slide I had earlier where we had boom, slowdown, recession, and recovery.
And I'll point out that the regime model that we have at BlackRock, so what I was showing here, that was just for the US regime, but we actually have a global version, a European version, so on and so forth. So it's also important to point out that factors that might look good in the US may not look good globally, because it depends on where the global regime actually is.
When the factors are not orthogonal, I'm overemphasizing what the discussants say. It's really important to look at the joint distribution, and that's where, in the last segment, maybe if you really try to be careful about that, there'll be less pitfall, and that's sort of really important. The other important issue is you mentioned for example, the VIX and momentum, or sentiment and momentum, how in various regimes it behaves differently. So, and I agree with that. For example, there's things like semi-variances. So you don't look just at volatility. We think of the .com, there was a lot of economic uncertainty because of new blueprints in the economy. That's a good sense of volatility versus the 2008, which that's a very bad sense of volatility. So even those, they come in different flavors, and you got to dissect them sort of in different ways given the economics.
I agree.
Yeah, good.
I
We've got a couple of moments of
agree.
general agreement in our conference so far. Okay.
That kind of gets related. I mean, it gets related a little bit. Like in our factor timing model, we have momentum unwinds, and we have dispersion. So dispersion picks up a little bit of the sentiment component. alongside momentum, because dispersion is picking up a little bit about uncertainty surrounding how much opportunity there is in a particular factor versus another. So that is related. We don't have something we specifically call sentiment, because we often call momentum sentiment.
For Josie, the BlackRock regime model looks like it goes back to about 1960, but it was obviously not built in 1960. It was built more recently and backfitted. So when you show returns to factors in different regimes, you wouldn't actually have known what regime you were in until, so there's kind of a look-ahead bias there. And Jen, I have the same question, say for your illustration number 1, where you look at linear timing strategy for using factor valuation. You're using a rule of, say, 1 sigma plus or minus, but I assume that 1 sigma is fitted over the entire period and not a rolling extending horizon known at the time.
It is a rolling extending.
Oh, it is?
Yeah, it's out of sample, yep.
And what about the 85% rule for high versus low?
That one's in sample. Yeah, so that was
Okay.
that was not meant to actually to be a foundation for building a timing model. It was just to show some of the differences in returns. Yep.
Okay.
And I will point out with respect to the economic regime model, as much as the definition of contraction versus expansion, all the data, kind of when we sit back in 1965 and we think about what regime we're in, the definition of a regime in February of 1965 is only using data up through the end of January 1965.
Of course.
Yeah, so yes, the key is it's all normalized, but it's normalized in a rolling fashion.
Yeah.
So it is still, we don't have this peak ahead bias. So when we're thinking of using it as a signal in a portfolio construction exercise, I mean, everything has a little bit of peak ahead in its data mined, but as much as possible, that actually doesn't have a lot of the peak ahead that you're worrying about.
So style factor risk premia are interesting for 2 reasons. One, on average, over time, they're positive. But more interesting than that, I think, is that they tend to persist. So when value is working, it tends to carry on working for a while, and then when it stops working, it doesn't work for a while. So I'm wondering if you tried doing any factor timing using endogenous variables rather than these exogenous macroeconomic variables. We're able to switch between different style factor portfolios by looking at which one has been behaving the most persistently in a recent look-back period, and that seems to work quite well. That doesn't use other variables, so I'm just wondering about that.
So we have that incorporated in our factor timing model via momentum. So if a factor has been performing well over a particular time period, you can calibrate the time period however you want. If it's been performing well, we call that relative strength rather than saying it's the momentum of momentum, because that can get confusing. If the relative strength of a particular factor is high, we actually overweight that factor. Whereas if its relative strength is low, we underweight that factor. So we do have an element of that incorporated within our factor timing model. Again, without the peak ahead bias, we're just looking at the previous returns of the factors.
Yeah, ours is the same. Is that your actual question, Jason? Is that whether or not we look at the past performance of the factor when we?
Yeah, so that's a factor in our factor. That's a predictor in our factor timing model. So that's a signal that we use for the portfolio construction.
And it does tend to work at 1 year and longer horizons. And I would say it is hardest to use though for momentum itself, just because momentum has turning points.
Yep. So that's why we have momentum, and then we have momentum unwind because of these turning point components.
My comment is on building the factors themselves. Most of the ones I've seen today are sort of dirty, as you might say, that you don't orthogonize them for other factors. I was wondering if you could comment on which one you prefer.
Okay. Well, okay, so because I used to work at MSCI, so I'm actually very familiar with a lot of the portfolio construction underlying the iShares ETFs. So I would say that at the end of the day, factors are unobservable, and you have to estimate what you think the factors look like. I would say that using a regression-based technique that is looking to truly identify factors orthogonal to all the other factors is what purists like us would probably think is the best way to identify a factor. Then from there, if you have this pure theoretical factor portfolio, or factor mimicking portfolio is another term for it, you then just try to mimic that portfolio in the most liquid, high capacity way you can. Of course, these portfolios are all long short, and we're talking about long only, so almost by definition, you're not going to be able to perfectly mimic them. So when you look at some of the papers that Andrew has written and I've written and others in this space, a lot of it is around what is the best way to perfectly capture that underlying factor return while controlling for all the other unintended risks. And still keeping that portfolio very liquid and tradable.
Yeah, within our group, within some of the more sophisticated investment vehicles that we have in the factor-based strategies group, we construct genuine long-short versions of these equity-style factor portfolios. Again, they're not perfectly uncorrelated with each other. At least they're long-short, so they've removed the beta correlation to each other. And for new factors or new insights to be entered into the model, they actually have to be pretty much uncorrelated with what we already have, or else we won't add them, because we want genuinely diversifying sources of risk. So it gets, your point is well taken, because for us actually, on our team, one of the most important things is we can construct a portfolio that has a really, really great return in the back test. We're all really good at data mining. We want something that's actually diversifying to the portfolio. And that's the key for us when it comes to factor construction.
Okay, so we're going to end it there. First of all, please join me in thanking our presenter, Jen Lender, and Josie Smith, our discussant.